Welcome back, Focus Learners. I'm absolutely thrilled to have you here for another edition of The Explainer. Today we're doing a really deep dive into a company that honestly almost everyone has an opinion on, but very few have actually unpacked at a fundamental level. I'm talking about Robinhood Markets, trading under the ticker HOOD. We're going to explore this fascinating duality in their current financial metrics, because on one hand, you have the story of just absolutely relentless momentum and profitability, but on the other hand, we've got a valuation that might make traditional investors break out in a cold sweat. It's a classic battle of momentum versus reality, and the numbers we've pulled from their latest performance metrics are frankly going to blow you away.
Okay, let's dive into this. Here's our roadmap for today's explainer. We're starting with Robinhood's explosive market comeback. Then we'll look at the profitability powerhouse, do a quick health check inside the balance sheet, hit the valuation reality check, and wrap it all up with what it all means.
So, Section 1, Robinhood's explosive market comeback. To set the stage here, Robinhood currently boasts a market capitalization of over $75.3 billion. To put that into perspective, they really aren't just a scrappy, disruptive startup anymore. They are an absolute behemoth in today's financial landscape. They've cemented themselves as a massive player, and the market is definitely pricing them as a heavyweight. But getting to that $75 billion valuation took a serious roller coaster of volatility. This journey is wild. Back in 2022, it was brutal. Investors suffered a year where the stock lost over 54% of its value. Honestly, a lot of folks were completely writing the company off. But then the turnaround began. We saw a solid 56% recovery in 2023, and then, no joke, jaw-dropping triple-digit returns. A 192% gain in 2024, followed by a 203% surge in 2025. This right here, this is the literal definition of a momentum stock.
When you compound all that momentum, you end up with an 851.81% three-year trailing return. That is just a staggering figure. If you held onto the stock through those dark days of 2022, you've been rewarded with a comeback that vastly outpaces the broader market. It's a phenomenal run for sure. But it really begs the question, is this pure hype, or is there actual fundamental fuel driving this rocket?
Which brings us to Section 2, the profitability powerhouse. Let's look under the hood.
Because behind all the retail trading frenzy and the massive stock rally, there's a very real, thriving profit engine at work here. Over the trailing 12 months, Robinhood has pulled in $4.47 billion in revenue. But what's even more impressive is the bottom line, nearly $1.88 billion in net income. They aren't just moving money around, right? They're keeping a really substantial chunk of it.
And speaking of keeping it, a 94.83% gross profit margin. That is a spectacular metric for any business in any sector. It essentially means the direct costs of delivering their services are incredibly low compared to the revenue they generate. It's the absolute hallmark of a highly scalable digital-first platform. Now, a great gross margin is one thing, but Robinhood's net profit margin sits at an incredible 48.20%. So what does this all mean in practical terms? It means for nearly every single dollar of revenue Robinhood brings in, almost half of it flows straight to the bottom line as pure profit. And what's truly mind-blowing here is that this represents a monumental 5,553% leap from its three-year average. They've aggressively flipped the switch from being a growth-at-all-costs startup to a hyper-efficient cash machine.
So the crucial point is how effectively management is actually using shareholder capital. Right now, Robinhood has a return on equity, or ROE, of 20.60%. For every dollar of equity, they are generating over 20 cents in profit. When you compare that to their three-year average ROE of just 4.42%, it is super clear that the underlying business operations have drastically improved in efficiency.
All right, let's pivot a bit. Section 3, inside the balance sheet.
First up, we need to check their liquidity. Robinhood's current ratio and quick ratio are identical, both sitting right at 1.26. What this tells us is actually quite reassuring. Any ratio over 1 means Robinhood has more than enough liquid, short-term assets to comfortably cover its immediate liabilities. The operations are stable and well-funded. They definitely aren't going to face a short-term liquidity crunch anytime soon.
But we do need to look at how this builds our understanding of their risk profile. Because while short-term liquidity is totally stable, leverage is indeed rising. The current debt-to-equity ratio sits at 1.27. That's about 48% higher than its three-year average of 0.86. Now, borrowing to fuel growth isn't inherently a bad thing, especially when you're generating a 20% return on equity. But it does mean the company is carrying more debt relative to equity than it historically has.
And now for the twist.
Section 4. The Valuation Reality Check.
Before we look at the exact numbers, let's frame this concept using the margin of safety. It's essentially the gap between the intrinsic fair value of the underlying business and the price it's actually trading at on the open market today. I want to define this clearly so you're fully prepared for the stark data we're about to look at.
Now, what's really interesting about this slide is that this is the absolute climax of our narrative today. Robinhood's last closing market price sits at a very lofty $83.95. But according to discounted cash flow metrics calculating the fair value of the actual business operations, the fair value price is only $44.94. The market price has completely undeniably detached from traditional fundamental fair value.
Negative 86.80%. Just let that sink in for a second. Robinhood currently has a margin of safety of negative 86.80%. What this means is the market is entirely pricing in a flawlessly executed future. Investors are paying a massive premium today for growth they expect to happen years down the line. The stock is priced for absolute perfection right now, meaning any slight stumble could be heavily penalized.
And we see this premium reflected across other valuation metrics too. The current price-to-earnings ratio is 40.75. This multiple is running significantly hotter than Robinhood's 5-year historical norm, sitting roughly 30% higher than average. The market is happily paying way more for every single dollar of Robinhood's earnings today than it ever has in the past.
The exact same goes for the top line. The price-to-sales ratio is 16.84, which is a 15% premium over its 5-year historical average. Now, to be totally fair, we have to validate this high premium by remembering that incredible 48% net profit margin and the 850% 3-year return we saw earlier. When a company is growing that fast and converting that much revenue into pure profit, the market almost never lets it trade for cheap. So it's really up to you to weigh that trade-off. Let's wrap this up. Section 5. What it all means.
Bringing all the threads together, we have two very clear realities existing at the exact same time. The bull case is spectacular, right? An 850+% 3-year return fueled by a hyper-efficient business generating a 94.8% gross margin and a 48.2% net margin. I mean, they are literally printing money. But the reality of the price tag is equally stark. The stock carries a steep valuation, trading at an 86.8% premium to its discounted cash flow fair value.
Which leaves us with the ultimate question. You've seen the fundamentals, you've seen the momentum, and you've seen the hefty premium the market is demanding. So I leave you with this to spark your own curiosity and further research. Is Robinhood's explosive growth and phenomenal profitability actually worth that steep premium price tag? That is the puzzle you have to solve. Thank you so much for joining me for this explainer, and keep learning.